Prices everywhere are rising. Groceries, rent, gas. It's like inflation is silently taking over our lives, shrinking the value of every rupee you earn. But what if I told you that one powerful financial tool could hold inflation in check? That tool is the interest rate. And when raised, it can be one of the most effective and controversial weapons to stop inflation in its tracks. Today, we'll break down exactly how this works, and more importantly, how it impacts your financial goals. Before we dive into how interest rates control inflation, let's understand inflation itself, the invisible thief. Imagine you've been saving up for that dream vacation, but by the time you're ready to book it, prices have gone up. Suddenly, what was within reach now feels miles away. That's inflation in action. Ever feel like your money's on a diet without your permission? Inflation is like a financial weight loss plan, but for your wallet. Technically, inflation is when the general price level of goods and services rises, and as a result, the purchasing power of money decreases. There's a reason why a movie ticket that once cost 50 rupees now costs 250 rupees. Over time, as the economy grows, so does inflation, and while a little inflation is healthy, too much of it can wreak havoc. But here's where it gets even scarier. If inflation rises too fast, it can erode the value of savings, making it harder for everyday people to afford basics and reach their financial goals. And that's where interest rates come into play. The Reserve Bank of India (RBI) has a trick up its sleeve to keep inflation in check, and it involves making some tough decisions. But how exactly does raising interest rates help with inflation, and why does it matter to you? Let's unravel this mystery. So, what exactly are interest rates, and how do they control inflation? Picture the economy like a car speeding down a highway. Sometimes, it needs to slow down to avoid crashing, and that's where interest rates come in, acting like a brake. Ever try driving too fast and had to hit the brakes? The RBI is doing the same, just on a larger scale. Here's how it works. Interest rates are simply the cost of borrowing money. When the RBI raises rates, borrowing becomes more expensive. This affects loans for businesses, home buyers, and even your credit cards. When people and companies borrow less, they spend less, and that slowdown in spending cools down the economy. Less spending means less demand for goods and services, which eases the upward pressure on prices. This process isn't instant. Raising interest rates is a slow-acting but powerful medicine for the economy. Think of it as a long-term solution with ripple effects. But when it starts to work, inflation begins to slow, and prices start to stabilize. It's like turning down the heat on a boiling pot. And it's not just personal spending that slows down. Businesses also feel the pinch. With higher rates, they're less likely to take out loans for expansions or new projects. When companies pull back, they're forced to keep prices competitive to attract customers, which further stabilizes inflation. But while this sounds great in theory, what does it actually mean for your day-to-day financial decisions? Let's take a closer look. Now comes the part that affects you directly. What does raising interest rates mean for your wealth, and how can you make the most of it? For starters, higher interest rates mean loans are more expensive. So if you're planning to take out a home loan or finance a car, expect to pay more in interest. This might sound frustrating, but there's a silver lining. While loans become pricier, interest rates on savings accounts, fixed deposits, and even government bonds also rise. Who doesn't love a little extra cash from their savings account? This means if you've been thinking about saving more, now is a fantastic time to look into fixed deposits or other secure investment options that offer higher returns in high-interest environments. Instead of losing out to inflation, you can actually grow your wealth steadily. And the best part? This can be one of the safest ways to protect your money. For those of you looking at the stock market, here's another insight. Rising interest rates often cause a dip in the stock market, as companies reduce borrowing and growth slows. While this sounds like bad news, for a long-term investor, it can actually be a hidden opportunity. Imagine buying quality stocks at a discount. They're cheaper now, but they could offer significant returns when the economy stabilizes. And let's not forget bonds. In high-rate environments, newly issued bonds come with higher yields, making them an attractive choice if you're looking for reliable, low-risk returns. Bonds can be a smart addition to your portfolio when interest rates are high, but if rates keep rising, are there risks to this strategy? And is there a point where this balance tips? Let's explore. High interest rates can be beneficial, but there's a flip side. If rates stay high for too long, borrowing can drop too sharply, slowing down the economy and even leading to a recession. If companies stop expanding and consumers stop spending, the economic engine could come to a halt. For you, that might mean fewer job opportunities, stagnant wages, and a tougher economic climate overall. So it's crucial to understand that while high rates have benefits, they also come with risks. The key is to strike a balance. Think of it as balancing on a tightrope. Lean too far one way, and you might fall. That's how it is with economic policies too. The RBI aims to find this balance by adjusting rates as needed, ensuring inflation is kept in check without stifling growth. But as a smart financial planner, you too can create balance in your approach. Avoid taking on high-interest debt during these times. Keep a watch on your spending, and prioritize saving and investing in safer avenues. So, how can you prepare for rate changes in the future and adapt your financial plan to stay on top as the economic environment shifts? So should your financial strategy. Here are some timeless principles to make sure you're ready for whatever happens next. First, stay educated. Rates can change, but if you understand the basics, you can adjust your investments and savings accordingly. Keep an eye on announcements from the RBI on how they affect loan and deposit rates. Second, build an emergency fund. In uncertain times, cash on hand can be a lifesaver. High-interest environments reward savers, so keeping cash in a high-yield savings account or fixed deposit is a smart move. Third, diversify. Don't rely on just one type of investment. When rates are high, bonds become attractive. When they're low, equities can be more rewarding. By holding a balanced mix, you'll be prepared for whatever the market throws at you. Think of it as having a financial survival kit. You're ready for anything. Finally, have a long-term mindset. Rate changes are part of the economic cycle. By keeping a calm, consistent approach to saving and investing, you'll avoid the traps of emotional, short-term decisions and keep your wealth building on track. So there you have it. How raising interest rates can control inflation, and what it means for you. By understanding this cycle, you can make smarter financial decisions, protect your wealth, and even turn economic shifts into opportunities. Want to learn more about smart financial moves in high-interest environments? Check out our next video on building a recession-proof portfolio. Subscribe, stay informed, and let's work together toward that wealthy lifestyle.